All right, ladies and gentlemen, I hope you're having a wonderful weekend. Today, I'm going to talk about literally how I make money without the stock market moving. This is an option trading strategy, and it's called the Iron Condor. So if you don't know, we're live Monday through Friday, 30 minutes before open. So you've seen me do this live. If not, tune in and you could watch. But I want to talk about exactly what this strategy is. Here's Robinhood. I'm going to show you guys how to execute it on Robinhood. And pretty much by the end of this, you should know how to execute this on any brokerage. You do need option level trading 3 to do this because it's pretty much like spreads. And if you haven't seen our other videos on spreads, go watch those. I will post those. Those are all here in the description as well. And this is just another tool that I want to show you guys. This has to do with knowing when to use a hammer, a screwdriver, a sander, I don't know, but hopefully you guys are seeing with the many ways you could use options, day trading, swing trading, all that. It's the more you're exposed to, you're going to know, hey, this is the right time for this or that. And this strategy is pretty cool because it is a literal neutral strategy. So the market doesn't have to do anything for you to profit off of it. Do I think you should use this all the time? No. However, if you really did want to do this and only this, there is a strategy that you could do, and that's what we're going to share here. But I want to go over all this stuff. I want to talk about what is an Iron Condor, briefly explain it, give some quick little facts, and then also just the strategies with it and even how I'm using it to grow this small account. And now the best thing I would say with spreads in general, if you are not able to watch the market all the time, you have work, you're busy, spread strategies, even just selling credit spreads in general, they could really, really benefit you. And this is one of those. But like we said, the main thing to get from here is that you could literally get paid if the stock market does nothing. If certain stocks do nothing, you could really, really benefit off of it. But here you see on this play, we lost $140 on this last week. We rolled over. And then again, that's another one of the videos here with spreads. The best part is, we lost $140 last week. I opened up the exact same play, and it was an Iron Condor, and we were up on it. And why did we lose? Because with an Iron Condor, if the market does nothing and the stock stays within, maybe I should redefine that. It's pretty much defining that the stock is going to move within a certain range. If it moves beyond that range, that is how you lose. And that's what happened. We were up on this play and then we lost. And I said we lost $140, but then we did the exact same play for now 2 weeks out, and then we collected 189. So even if we end up actually being right on the range that Apple is going to stay in, we're going to make that $140 back that we lost. So that gives us all the money back, and we got $189. So we'd make $50 on top of that. So again, the more you expose yourself to how to use these spreads, realistically, all it requires is patience, because you could even turn a losing trade into a winning trade. And then on the reverse, you guys even saw that play over the weekend. I think a lot of you guys hit it along with me. Costco was an awesome play. They had their earnings, and if you kind of see how they played out for earnings, it really didn't do much, and we were able to profit. It was a $50 risk, and we walked away with like $150. If you held it till expiration, you got $200. And I'm going to talk about that here, when to sell it, when not to sell it. But if anything, it's just like any of these spread strategies. As long as you guys don't go crazy and take too much risk, all of these are defined risk strategies. So as long as you don't expose yourself to something too big and you know what you're getting to from the beginning, it's just very, very easy to manage, and it gives you a lot more room for error. That's the best part about spreads. And quite simply, if you want to know what an Iron Condor is, it is selling two spreads. That's it. I know a lot of people, we could go and talk about this, and we're going to get into depth with it, but at the end of the day, all it is selling two spreads. You're selling two credit spreads on both sides on the same expiration on the same stock. And like any spread, if you are selling the spread, you want this spread to expire worthless, so you could sell the spread, collect the full credit, and then it ends up expiring worthless. You keep that money, the risk is off the table. That's what you're doing here. So by selling a spread on the call side and on the put side, you're hoping that it stays outside of the put range and outside the call range. Boom, very, very simple. So let's get into it. Make sure you guys like the video as well. But what is an Iron Condor? An Iron Condor is an option strategy that involves 4 different contracts. Some of the key features of this strategy include, and right off the bat, the key is it's a 4 option play. So if you haven't seen it too on Robinhood, how to do it on mobile, you got to press the select button in the top right. But to make an Iron Condor, you just come here, and again, I owe $90,000 to Robinhood. You guys, if you haven't seen my other video on owing them $30,000, we got assigned on one of these spreads. That's what's going to happen. And so it's going to usually lead about 1 day to clear up. So it's not that big of a deal, but go to the trade options. And what you would do here is you would just sell. So here's the call side. I'm not picking anything specific here. You sell one expensive contract, buy the cheap one, as you see, called credit spread. Then you go to the put side, and then you do the same thing. Sell one of these, buy one of these, and boom, a 4-option order. That is a Iron Condor, simple as that. Now, again, I'm just showing you in general how to do this, but the key is how you set the range. Now, this, I even got this from Investopedia. I'll break it down, and to give you guys a different insight, because there's many ways people go about this, and they even acknowledge how you could go about it in many ways. But an Iron Condor is a spread constructed by selling one call spread and one put spread, same expiration day, on the same underlying asset. So literally, you're selling a call spread and a put spread. Both of them should return a credit. If you wanted to do a reverse Iron Condor, you could literally just flip it around, and then you would just be buying 2 debit spreads, but that has a whole different probability of what you're expecting, and it still has a capped gain. I would just go with selling the Iron Condor. Now here's where it gets a little bit more informational. All 4 options are typically out of the money, although it's not a strict requirement. And now so far, any of the Condors that I've done, I remember I did that even on Boeing. If you guys saw, we did that on Boeing last week. We made like $100-something off that. We had the Costco, we were up on the Apple, and then lost. Every single one of those was out of the money that we did. So compare that to some of the credit spreads where I've been getting higher credit, like on the Home Depot, right at the money, and it falls out. That's a lot different, but most of the time it's selling it out the money, because you could still collect a decent credit by selling 2 spreads out of the money. But again, it's not a strict requirement. So when I did the rollover, the second rollover on the Apple now, because we sold the out of the money Iron Condor, and now I wanted to pretty much get that same range, I widened one leg on the put side, but the call side was in the money now. So keep that in mind. This next part gets even interesting. The call spread and put spreads are of equal width. Thus, if the strike price of the 2 call options are 10 points apart, then the 2 puts should also be 10 points apart. Note that this doesn't matter how far apart the calls and puts are from each other. So this is saying the distance between your strikes. This is where you guys have to keep it in control now, because again, somebody asked, so let's go to that Apple Condor that we have here. You can see here's the 4 options that we did. We sold a 222.50 call and bought a 225 call, sold a 215 put and bought a 212 put. These are both $2.50 apart. That's what it's saying. This is where some of you guys are going to run into problems. I see some people, they'll do these $5, $10 apart. You can do that. That's going to require more collateral. Somebody even said now, since this requires $250 in collateral and this requires $250 in collateral, do you need $500 collateral to do this play? No, you do not. You only need the initial collateral to cover the distance between these 2 strikes, because the system is intuitive. Again, when you have to put up buying power, that is literally you're funding the deal, and you're just saying you could cover the max loss. So the system logically knows, or if you win on this one and you win, it goes up, you'll lose on that one. Or if you lose on this one, the other one will go up as well and profit off you. So you really are only taking the risk on one side, because that's the only way you're actually going to reach max loss, is if it moves outside of the range. So in this case, you could see the break-even price by selling the 225 or the 222 and buying the 225. Our break-even minus the collateral here, or the credit, is 224.39 on the upside and 213 on the downside, meaning if it stays lower than 224.39 or higher than 213 by October 18th, we will win or collect all of this money, or at least this is break even, saying we won't lose any money. But the collateral requires only 250. But now be cautious, because this spread that you do, this is just the easy way. If you guys really, you could go ahead, experiment all you want, but I really strongly encourage you guys, just don't play with getting these wide ass strike prices and saying, they're $5, $10 apart, I can make this much. And that is how people blow up these accounts, or this is how people just fail at this, where they're making too big of plays or too big of these spreads just to get a little bit of collateral. It's not worth it at all. It literally reminds me of Willy Wonka and the Chocolate Factory. If you guys just stay in line and you don't get too crazy, these are high probability strategies and they could help you. And now that's the thing they even noticed. Speaking of probabilities, most of the Iron Condors, if they're within like one standard deviation and they're pretty close to each other, like here, this plays, the higher the credit, it's the same logic. The higher the credit, the lower the probability of profit, and vice versa. So if you get a low credit, the higher probability. But if you just don't get too crazy and you don't do anything good, you're going to get the money. But most of these plays are about 30 or 40% if they're close to the money, and then anything after that, it turns into a 70% probability depending on what you're getting. But that's where it's going to be on you guys to examine which strikes, because sometimes you'll do an Iron Condor and you can make way more money on the put side of it, and then you'll sell the call side and you really won't make that much. You have to ask yourself, is it worth it to put a ceiling on that for the extra 10, 20 bucks? That's what you'll have to see, and that's what we even talk about with all this. But moving forward, it even says most often the underlying asset is one of the broad-based market indexes such as SPX, NDX, or Russell, but many investors choose to own Iron Condor positions on individual stocks or smaller indexes. So it makes sense. Why is this commonly the case? Because and if you guys have heard this is what I've even said with buying options. I don't like to buy during volatility or anything like that. I don't like to buy these SPY options because it takes a lot more for a broader index to move. So think about how a Iron Condor benefits. You don't want it to move. You want it to stay within a certain range. It's harder to move a whole index than it is to move an individual stock or have a bad piece of news move it. So keep that in mind. And it says here, this one, I don't really agree with it, but this is what it's saying. It's saying when you sell the call and put spreads, you're buying the Iron Condor. The cash collected represents the maximum profit for the position. So it says by selling both sides, even though you're selling premium, you're buying an Iron Condor. The real way I refer to this is a normal Iron Condor or a reverse Iron Condor. The fact that you're selling premium, I like to just say you're still selling premium. So I say you're selling it, and then to close the Condor, you're buying back anyways. But the key is if it's selling two credit spreads, that's a normal Iron Condor. But if you, let's say now, do two spreads that are debit spreads, and it's the same, a call debit spread and a put debit spread, that would be a reverse Iron Condor. So some people would say you're selling the Iron Condor in that case. And think about why someone would do that, because now on the reverse, with a reverse Iron Condor, if you believe the market is going to do anything but stay in that range, you could put a little bit amount of money up there to receive the max risk between the strikes. But again, like any premium sell, the cash you collect is the maximum profit you're going to receive. And the maximum loss is the credit minus collateral. So in this case, we got $189 credit. The difference between these strikes is $250. So credit $189 minus $250. It's about like a $60 risk total. That's our max risk we could lose. And then if this expires worthless, the max we're going to make is that $189. And then finally, my favorite, it represents a market neutral trade, meaning there is no inherent bullish or bearish bias. You literally, by doing this play on whatever asset or company, you're fairly neutral. You're saying, I don't think it's going to go up, or I don't think it's going to go down. I really think it's just going to stay within this range. And now if you saw that Boeing play, we did a Boeing last week or about 2 weeks ago with one of these Iron Condors, and it actually ended up working very, very well for us. We sold it for like 160. I ended up closing out for a little bit extra money or less money, but it was pretty good. Where was it? I think it was longer than that, right? It was right after the pop. It was right after this pop here. We sold it around here. And it was at around 381, and I sold an Iron Condor, and the break even was 384 on the upside. So I pretty much said Boeing wouldn't go above 384, and then I said it wouldn't go below 370. And this is what I'm saying, market neutral, because even though you're saying the stock doesn't move, it doesn't mean that the stock isn't going to move. The key is where it's going to end by expiration or close to expiration if you wanted to cut out early. And look what happened. It right away, the day after, it shot up and we were down on it. It went to 390, but then it came back down to 384. That's still above our break even. Shot back up to 388, and then it fell down and fell down. And then literally our expiration was literally on Friday. It dropped below to 363, and our low side was 370. So first we were losing, it went above our high range, then it went below our low range, but then it bounced up, and then boom, ends at 373. That contract expired worthless, but I did close out earlier. I think I closed out for $145 versus the $165 I could have collected, and I left $20 on the table, and that's what we're going to talk about, because that's part of how to play these. But simply, that's what an Iron Condor is, and here's some highlights moving forward as we get into how to play this and when and what to be looking for. You make the money by having both spreads expire out of the money, allowing you to keep the premium or the credit that you got up front. This is the simplest thing you need to understand. That's it. You're literally just selling two option credit spreads at the same time. If you're selling it on the put side and you're selling it on the call side, just think logically, how are you going to win? Both, if you're selling these, you need all of these to expire worthless. How are they going to expire worthless? Apple stays above 215 here, and then Apple stays below the 222.50 here because you sold that one and you sold that one. And again, these are the other insurances that you bought, but I don't have it here in writing. We should. The key to understand, and this is where the break even comes up, you need both of them to expire. And now I guess how credit spreads could even help you, or Iron Condor, you have a buffer. So again, the minute you collect your credit, that's it. That's off the table. You have that money. So like even on this play, let's say Apple, let's say it closed, right now it's worth 211 for this spread. It's not factoring the fact we got a credit of 189. That's why it says market value negative 211. It's not counting our credit, but that's why you take the credit minus the value. It's a $22 total loss, but that's your buffer zone. So again, you want them both to expire out of the money, but then you also have that premium with your credit. But that's just the simple way to do it. So if you're going to go sell a premium, you're like, well, does this make sense? Is this a good play? Ask yourself, will both of these expire out of the money and end up worthless? So now review that on the other side. Someone's even asked me before, is it a good strategy to buy options and buy puts and calls? No, because again, both puts and calls could expire if the stock doesn't go to a certain price. And the best part is that buffer we're talking about, if you sell the premiums early and you get a higher credit, even if it stays near those levels or doesn't even move at all, or it just literally you sell the credit and the stock does nothing for the next week or two, that's it. You're just every single day you're just collecting that theta, that premium. There's that. And then the next thing now, market neutral trade doesn't mean the stock doesn't move. That is where but you are saying that it will move in a specific range that you define. And this is what I call the oscillation. This is where you got to know where the puck is going. This is how I even, with Boeing, I know it could move in high levels. I know Boeing has certain ranges, even the S&P. This is where it might be good for some of you guys who do technicals. I don't do technicals. I do it, literally with Boeing. I've looked at their filings, and we've looked into where they have buyback programs. We've seen where the market has responded, where there's a lot of buildup, and what it takes for the company to do stuff. But again, you could use different strategies, but you got to kind of know where it's going to go. So it doesn't mean that you pick this on companies that aren't going to move. It's on you to determine what range it's going to kind of move in and understand the volatility of that. So again, you could do the same thing on Tesla. Tesla's a great company to do this on because it's going to have high premiums. It's going to move up and down a lot. But at the end of the day, it'll just stay in the same price. That's something a lot of people, if you ever played Tesla, you'll notice, imagine from May till now, it's been doing all these big moves, but it's stayed in the same exact place. And, sometimes it will go down a little lower. It's all about the timing on that. And again, the time of which you're selling your spread or your Condor. Next, and this is very, very important, you can make money by premiums being high and dropping over time. That's what we said, collecting the credit. And another way to look at this is you could sell an Iron Condor. It goes 50% in your favor just by the premium being high, and then it moves in one direction, or your range is so wide it kills the other side, and you'll be up 50%, and then you could close out before it expires. Sometimes that makes sense to do, and this is the key, is that it makes way more sense to cut the trade before expiration to lock in gain. Because this, when we go to the strategy with spreads, it's always better to wait till expiration, but sometimes it makes more sense. Usually, I still think a couple days before, and if you're able to secure 80, 90%, it makes sense. I wish we did that on the Apple last week because we were up on it the day before. I didn't realize, there was such little value with it. It probably would have made sense, or even in the morning on the Facebook that we were down on, that was a credit spread, but it's the same logic. Sometimes it makes more sense to just take the trade right then and there, but this is where you're going to have to determine it for your account, but be careful. Don't want to do this too quickly. And that's part of the strategy, like we said, pushing these to expiration. A lot of you, and the problem I've seen with you guys doing spreads so far, you're not understanding your max risk. So some of you guys, it's going against you. Like this play, like it's a max risk of $60. So some of you will trip out. It starts working against you. There's still there's a whole week, 2 weeks, even a month of time left on the credit spread or the Condor, and people are like, oh, should I cut out for a loss? No, don't take the trade if you're not willing to lose that $60. And once you come to terms with what you could lose, awesome, play that to your advantage and just push it to the wall. Let it come towards expiration, and then you'd be surprised what sort of moves that it could make. But that's the best thing. The only time you should really look to cut it is if you're up a decent amount. That's the way I look at these, is that if it goes up 50, 60%, like almost right away after selling it, the question is, well, you could take your profits now, or you're already up 50%, but you're taking the same risk you were willing to do for double the money. So if you wait another day, you're technically taking the same risk for less money. you might as well cut it or see what you could do. But then again, too, it's like the probability. So like that Boeing, at the end of the day, I tripped out on Friday because they had bad news, because I covered the spread on Friday. It only had like $25 left of value in it, and I could have held it for 2 more hours and made the extra $25. Literally got paid $10, $12 an hour to hold it. But I was scared that Boeing would drop $3 in that day, and that would take me to my break even, and I would lose the other $140 that we've got so far. So that's why I cut it. But probability wise, it probably would have made more sense. Same thing even with Costco. I could have made an extra $40, but I cut it here because I was like, well, Costco's $4 away. It already moved $4 in that 20-30 minutes. I had to hold it for like another 5 hours. I was like, I'll cut it. That's where I took it. But again, sometimes it just doesn't make sense, because if the credit's so low already and it's, there's an extra couple dollars left in there, your probabilities are low of it working against you. But I should have, in retrospect, I should have taken them. But in most cases, if the market's as volatile as it was, I'm cool with paying a little bit of that premium, taking less of the total gain to protect myself. But watch out for that and keep that in mind, because this is where it's going to mess up a lot of you guys. It has to do with the profit taking. But I encourage you, just keep it simple and follow the spread. You have a defined risk, and just keep it within there. Don't try to get too crazy. Don't try to cut in this and that, because again, if it goes against you, you wait towards expiration, you roll it over and give yourself more time, and then you do the balance. Eventually it's going to work for the most part. Depending, it's all about, literally just a matter of time. How much time do you give yourself? But don't get too trigger happy going in and out of a play. Some of you, again, that's why I said it's better to do these strategies with spreads if you're not watching the market all the time, or if you have discipline, but if you're always trying to day trade this and that, you're going to keep moving in and out. It's that whole analogy: take 2 buckets of water, put one in the other bucket, the other, and just keep going back and forth. Eventually both buckets are going to be empty. Let time play and let the nature of these options work. You're selling time. Let time work for you. Stop trying to do the most. But on the reverse, if you do make a sizable portion of the premium right off the bat, it does make sense to take the profit there. So now that we have that in mind, let's talk about the strategy. And this is where it gets really interesting. It's how to use this. So you guys are seeing me use this in my arsenal as supplementing the credit spreads, because sometimes there's plays where, like we've said, with the credit spread strategy, I've been telling you guys, sell credit into the direction. So like Tesla, remember Tesla was running up the other day, it was on here, and what did we do? We sold a credit spread into this. We sold a call credit spread, and then it came down. And then as it was coming down, I said we could either do a Condor or sell another one, but it makes sense where the volatility is high, and then you could use a Condor to say, well, I want to sell one of the directions that's overpriced, but then you could kind of protect yourself in that way too, just in case, and kind of box it in. So it's that, or depending on if the company is a difficult company and it's not something that's just going to go in one direction or the other, it's good to use those credit spreads. But really, at the end of the day, you have to really think, how do you want to utilize this? And what I mean, the first thing I'm saying here is that you could use this to supplement, or you could use this as a full-blown strategy. You could really use this and just sell weekly, monthly, or yearly ranges on a stock if you really wanted to keep it. I could say technical, but it's honestly statistics. You could go take the average of how much it's moved. You could call it a moving average, but just literally say, hey, statistically, what is this thing going to do? And you could just literally sell the ranges if you really wanted to, and say, it doesn't move more than this in a week. If I could get this much credit for collateral, it's just simple. You're being a bank, and if the volume of what you want to do is going to be relative to how much risk you want to take in that. And I encourage you, keep it small, but you could just sell those ranges and call that a day. You could sell weekly, monthly, yearly ranges, and that's it. I'm not too big of a fan of this one, because the thing I don't like about the Iron Condors with this range is that you could use the same approach to sell normal credit spreads. And why I don't like Iron Condors, because you could screw yourself up, because even though you could play the range, you're putting a ceiling and a floor. Whereas a credit spread, you're just kind of putting a floor, and you're saying it's going to go above this floor, whether it's a put or a call. But that way, so a credit spread, you could be right, and if it goes up too much. So think about how you need to apply. So when do I use an Iron Condor? If it's going to stay within a range. So it's like here's for Tesla, for instance, I know it's going to stay in between 345, or let's say 350 and 320. I know it's going to stay there for the next week or month. Sell the Condor so you could get both sides, because again, it's saying I know it's going to stay in there. I know it's going to go up and down and up and down, but I don't know which direction is going to be more bullish or bearish or this and that. But I know for the most part, there's not too many things that are going to drive the value out of that range. However, if you think Tesla isn't going to go down, but you don't know what range it could stay in, and you think, well, I don't think it's going to go down from here, but it could keep going up a lot, you would sell a put put credit spread, because again, if you sold the Condor, and it bounces, you'll be like, okay, you're right on that put credit spread, but by selling the call credit spread, if it bounces too high, you'll end up losing on that trade. So it's like Apple, we lost on that one. We were up on it. Again, it was dropping, and we had that Iron Condor, and we said, I sold even a high range. I said it's not going to go too high. I just said it wasn't going to. I wanted to take advantage. We got more money on the put side, but I said the Iron Condor, I said it's going to stay in the range. I didn't think it was going to break out of 225 in 1 day or 2 days after being, this low, but it did. If we sold the put credit spread, we would have actually made more money. And then even at the time, I only got like an extra $40. So hopefully you're seeing when to do it is when what you think with the company. But Iron Condor will screw you up if the market does more than you expect. So if you can expect the direction, do the spread. If you can expect the specifics, do a Condor. So that's going to be really key to understand. The next strategy is playing earnings. And this is now going to be my favorite strategy that I'm going to show you guys, because this has to do with option pricing. So I'm saving this here for the end. You guys could tag this in the comments if you want, but I think you guys should just hype everybody up in the comments and let them know, like, this is gold towards the end. Make them find this, because you guys, this is for the people rewarding watching this long. I know y'all want that fast food options, but this is a strategy that takes time and this and that. This is the golden strategy for earnings and how to mix in stuff we've already learned in option pricing. Let's go to the option chain. This is what we did with Costco. And this is my main one here. I let the market makers, and again, you don't have to do this with earnings. You could do this now just on a daily basis if you really wanted to. I might even try this. We could even try this for a week. You could literally do zero work at all. And okay, maybe that's overstating it. None of this is a recommendation for financial advice. Please consult with a financial professional. Option traders friendly risk. You can lose often most of your financial investment. But what I'm saying is that you could do minimal work and let the market makers do the work and sell ranges around what they're pricing in. So you could literally let them do the work and then go from there. And what I mean by this is option pricing. This is what we've looked at. I've showed you guys this before. Come to any option, and Costco had earnings, and this is what I did with the earnings play. And again, how do you use Iron Condor for earnings? Well, earnings is going to have an expectation, and you're going to say, well, earnings is coming up. I know they're going to report. The company never moves more than $5-10 with earnings. You sell a Condor, and that's what we did. We did a daily Condor on this. It was a $50 max risk, and we walked away with $160. If you held till expiration, you got like $180. But what I mean now by letting the market maker do the work for you, it's very, very simple here. You come to the option chain, come to whatever date it is. So October 11th, this is what the market maker's pricing in for the end of this week. November 15th, this is what they would be doing the same calculation on this date. Will give you the same thing. But you got to be careful, because again, if the underlying asset moves, the market maker could be wrong, but they usually have a buffer. So you have to keep that in mind. And you could start to sprinkle on some of your own thoughts and opinions with the stock market from there. But what do? Take it in. So this expires October 11th. The stock's trading at 291.47. Here's the 290. So this 290 call is $1.47 in the money, and it's going for $4.50. So minus $1.40 from $4.50 or $1.47. So literally $1.50 leaves you with $3 flat. That means the market maker is pricing in $3 on the call side. So they're saying for sale right now, if you bought it at this price, the break even is $4.50 above 290 with $1.50 intrinsic. They're pretty much thinking it's not going to go above $3.50 from this price. Why do they believe that? Because if they believe that the stock would be more, what's going to happen? The option price would be more expensive, and that could even happen on Monday. Same thing on the reverse side. The 292s, it's $1 in the money. So this one's going for $3.95. It's literally going for $2.95. So they don't think it's going to go lower than $2 on the downside. Because again, if they did believe that by October 11th, they would charge more money for this play. So you could do this for both earnings. This is a calculation. This is why I'm saying this is important here. You've seen me do this to find mispriced contracts. I've showed you this calculation. I do this on earnings, or I'll do this on the earnings day and say, hey, the market maker's pricing in a 4% move by the end of this week with earnings coming up. They think it's going to move 4%. And then I would look at the rest of the contracts and say, I agree with the market maker or disagree. If I disagreed, and the market maker's pricing in too small of a move. So here I just told you, they're not expecting it to move more than $3 on the upside and $3 on the downside. If I disagreed, that means the contracts are mispriced. I would look to buy the contract. if that was the case, but I'd have to see where I thought it could move. But now if I did agree, usually I wouldn't play it on earnings. But now in this case, if you wanted to take the risk and you really believe that the market maker was right, you could just go play within this. So boom, if the market maker is saying it's not going to move more than $3 on the up and down side, let's see how that play would look with the Iron Condor, and let's do that right here. Put in Costco, trade Costco option. So October 11th. So think about it. $3 on the upside would essentially be, the stock's going to go to like what, 290, 294.50. So we could say pretty much 295 conservatively. So let's see how that would look. You'd come up here, sell the 295. You'd sell the 295 and buy the 297. And you see that's a $74 credit. But here's another thing you could do. Don't get it twisted here. What else could you do? If you think it's going to go 295, you could sell the 292 and buy the 295, because depending on how much credit you have. So think about this. 292 and 295. If you got $112 credit, you're realistically saying add $1.12 to the lower strike price. You're saying it's going to go to 293.50. But now that would actually only be a $2 move. So that's a little different here, but let's be conservative here. And we'll just go with selling the 295. So you sell the 295, buy the 297. That's your call credit spread. Now let's go to the put side. Again, another $3 here from the low. That would be like what? About 287.50. So come here to the 287.50. We're going to sell that. And again, if you want to know if you're trying to do spreads, the key is keep it simple. You sell the expensive one and you buy the cheaper one. So boom, 285. So right, you guys see here, Iron Condor, it fills it in right there. Again, now we're following just what the options are pricing. And now depending on Monday, this could all change. So that's the issue, the downside of using this strategy. The stocks are always moving. The probabilities are constantly changing. That is another fallacy that is easy to fall into, is where you think these are fixed. It's not like a coin toss where it's always staying the same. No. This is where I've made literally all my money in my life, is that probabilities and people's expectations change. This is a model. This is for the banks. This is how they underwrite this stuff safely, because over a large sample size, it's not going to move this. However, things could happen. That's why when there's some little news interpretation lessons. That's why when stuff that happens that hasn't happened before, this is why it gets really important. So again, keep this in mind when you're doing this. And now you could also even see what's expected. And if you want to be conservative or more riskier, whether you agree with the market maker or not, you could widen this and sell stuff further out. Instead of selling these 295s, you could have sold the 302s in this and do the math of how much credit to collateral. But essentially in this case, if we did this one, followed the market maker, we would get a total of 134 credit. And now here's the issue. Look at the spreads. I don't know if this is because the market's closer, but what you're doing, you're going to put in one contract and set the price of it. So this is where you guys run into issues with Robinhood. Again, it's the Indian, not the arrow. I'm starting to really like Robinhood, but this isn't the actual price. This is just the spread. So that's why it's saying we'd collect 174 or 134. That's the difference between these. You put in how much you want. I would start with 134, maybe even higher, and then work it around and see where it fills at. But essentially, we'll assume we got $134. Now do the math. $134 is your total credit. The max distance between these is $2.50. 250 minus 130 is 120. Your maximum loss is 120. So boom. And this is for the end of the week. So it's pretty much saying on Friday, if Costco stays within this range and pretty much doesn't go higher than 295 and then doesn't go below 287, you'll walk away with 134. And again, the break even is actually going to be a little higher. Your break even will probably be like, literally your break even is going to be just adding it to the credit on this side. So your 134 added to the 295, your break even is going to be 296.34 by Friday. And then on the put side, it will be 286.20. There's your and again, that's how you factor break even, just minusing the credit or the premium. So in this case, this is part of the strategy. That's what I'm saying. You don't have to do anything. If you really wanted to even play alongside the market maker, that's what they're pricing in. You could go about and do that. This is a full-on strategy of what you could go and do. And this is what I like to do with it. That's why when I'm kind of unsure, and then again, if the credit, now imagine that play, the market maker was pricing that in, and then the credit was like $180, $200. I would jump all over that, because then I know the market maker and it's mathematically priced in my favor, and I get a high credit to collateral. I'm kind of down with that. Or if I think I'm a little smarter than the market and I could spot a divergence or an issue, I could capitalize on that. But that's what I like. That's how I like to use these, especially even if I'm unsure. I'd go about doing that. And it's like I said, you could go look at monthly, weekly ranges, or you could even just go follow along with what the options and the market makers are pricing, and they're going to be right most of the time. It's a very minimal effort thought process, but be careful, because if you blindly do that, well, again, I don't know if that's a sound investment strategy, right? So keep that in mind. But at the end of the day, diversify this with your credit spreads, okay? You don't always do credit spreads, and you don't always do condors. You can, though. That's if you really wanted to. Like I said, if you're selling these monthly, yearly ranges, if you gave yourself bigger, wider ranges, there is people who do this. And again, a lot of these strategies, spreads, Iron Condors, all of these premium, these are used by big hedge funds. This is how they pad the stats. This is how they are able to hold equities, bonds, take certain risks, and they'll use this with free cash flow. And it's literally, most of these is just cash secured. Because again, you don't need to make a position. You could have unused cash, and you're just taking the max risk. So if you do this super far out and super statistically, the more money you have, you could take the easy 99% probability plays and only collect pennies on the dollar, but it would just make sense to do. But if you're selling wide enough ranges, it could work. However, I think if you diversify this with your credit spreads and then knowing when to buy the options, as you guys have been seeing us do live, it'll be pretty good. But be careful not to fall in love with these or any of these spreads, and just understand how you could lose. Like I said, with the Condor, the only way you're going to shoot yourself in the foot if you're actively trying to trade these is that you're kind of biased towards a direction, but then you select a neutral strategy. So if you're thinking, I think it's going to go up, but you don't know how much it's going to go up, go do a put spread and sell a put credit spread versus selling an Iron Condor, because if it does go up but then goes up too much, you're going to end up losing on a Condor. And that's what you have to be careful for with Condors. Even like a butterfly, the minute you say, I think the stock is going to go directly here by this time, that's really, really hard. It's very hard to even say a stock is going to go up or down. But on top of it, to say it's going to go up or down by this date and exactly this, that gets even harder. That's going to have a lower probability than just saying, I think it's going to go up and give me a buffer. So keep that in mind. And lastly, to drive this one home, it's better to wait to expiration to decide the move, if and only if your collateral is controlled. And so what I mean by this, sell the Condor, even if it works against you and you're saying, well, I'm up 60, 70%. You have to ask yourself, is there a lot of time on the Condor? If you're up a big percentage on the Condor and there's a lot of time left and you already got 50, 60%, I would close out of it and I would take my money if that was me, because I'm not going to hold it for that duration to try to make the other half. We could go move on. However, if it's fluctuating 10, 20%, I would wait till closer to expiration and decide now, okay, now there's only a day left, or it's the day of expiration. Should I cut out? That's when you wait. Or it's moving against you. If I sold a Condor and it went against me 50% right off the bat, I'm not going to sell it. I'm going to wait till expiration to decide the move. Because like, again, that's what happened with the Boeing. It's going to oscillate. It's going to go up and down and end in a range. So don't panic, but it's the only way to not panic is if you truly know what you're going to lose. So I'm not encouraging you to be reckless and just say, oh, I'm down, forget it, push it to expiration. Because again, if it really gets out of the range and like there's no chance of coming back, it'll probably be a shitty play and you could literally go take a way better play with the same credit. However, you should avoid that off of the purchase. You make your money on the buy. Just like we've even talked with real estate and anything, you want to just make sure your collateral is controlled and you're getting a high credit for a decent collateral. And then that way it just makes sense why you'd want to hold it. But you know, if the credit spreads are $5, $10 apart and you could lose $500, $1,000 and that's a big portion of your account, then yeah, I could see why you would be down and be worried. But like on that Apple play, it's like, if we're only going to lose $60, why am I going to trip out if I'm down 50% right away? It wouldn't make sense. So just think Willy Wonka and the chocolate factory again. If you keep it controlled and you don't try to disrespect the market and get greedy, you'll be good. Even that's what happened even with this week. We killed it on the spreads. I would have had, it sucks that we only walked away with like what? That was the goal, around $200. We got 173, but we had to roll over here to the Facebook and the Apple, but we lost $80 on this one. And we lost $130 here. I would have had a $400 week on a very small account. We would have made 40% instead of 20%. That's insane. So you could see you can make a decent amount, but when you get carried away, like if I did these plays with more time, it probably would have been a lot better. Or if I literally waited in between how often I'm doing the plays. And that's the thing too to understand. This strategy is better with time. You have to be patient because, like I said, if you're working all the time, this might be beneficial for you because you're not always looking for a play. But if you do a credit spread or Condor and it works out, boom, you take your money and then you do another one, then you do another one. If you think about it, most indexes and stocks all move the same. So everything's kind of in the same place. So you're just kind of just continuing it and rolling along without really knowing it, when it might be better to take profits, wait a little bit, and let everything come back down there. So that is pretty much it, ladies and gentlemen. I hope you guys enjoyed that. Let me know your feedback. If you have questions, I'll try to answer them. We're going to make more follow-ups. Please watch the spread videos so all of this makes sense. Be smart, be responsible. I think a lot of people have been having their eyes open towards this, and I think they're loving it, and you guys are even seeing how you could literally build a profitable account. I love this. Literally, it's turning. You could literally watch the stream and make money just by being here, and it's like you guys are now actually building accounts. Play the odds in your favors. Don't get too greedy, and don't do too many plays at one time. You know, I need to tone it down myself with that. You know, I'll take my own advice and say that we got a lot of plays, but that's, I wanted to get greedy on this because I'm like, I could do a lot, but I could have hit my $200 a week goal very, very easy if I just wanted to keep it there. But you guys know I don't like to really keep this amount, but at the same time, you guys could even build if you really want. We'll have to make another one, or maybe we turn this account to it. You just use this as side income. You could just keep it very, very simple. Like I said, you don't have to look at it too much and let the time work in your favor and act as the bank. Pretty much, you are selling insurance. So I'm going to leave it there. Hopefully you guys enjoyed it. Hopefully I see you on stream, and let's go.